Elon Musk once said that Tesla's car prices were at an embarrassing level, owing to the rising inflation. The Tesla CEO also said that Tesla plans to make EVs affordable, and so this could be why the automaker is starting to cut prices for some of its cars globally. Although the prices of cars may be favorable for Tesla EV buyers, American investment management firm Morgan Stanley has said that Tesla's price action may be accelerating a deflation in electric vehicles. Hey guys, welcome back to Tesla Tomorrow. In December, Morgan Stanley analysis said that Tesla's sliding stock price represents a buying opportunity. However, the firm still cut its price target from $330 per share to $250. Tesla's stock finished out its tumultuous year in 2022 with yet more turbulence, and the cut to Morgan Stanley's price target did not help at all. And now the firm seems to be getting more and more concerned about demands, as it has stated that there is an oversupply in EVs in the market, as opposed to the idea of an acute undersupply of electric cars. Could the EV industry be possibly seeing a demand decline? Let's find out. But before we do, if you like this type of content, don't forget to hit that like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Investors will know there's an oversupply when companies start to slow down their EV plans rather than continuously grow them, which is what's currently being seen with many EV makers. And so it's fair to say that there is no oversupply of electric vehicles, but rather an oversupply of compelling electric vehicles. Many analysts believe that in the coming decades, more than 1 billion EVs will be sold as global EV production goes up. There's no doubt that electric vehicles are the future of driving and mobility, and although newer materials may be used in battery chemistry and innovations will keep taking place, the trend is irreversible for several reasons. When the first electric vehicles were introduced, very high initial cost, low battery range, low speed, and much lower environmental concerns resulted in the industry not taking off. However, the last 10 years have seen universal interest among original equipment manufacturers, customers, and governments, resulting in huge investments being made in electric vehicle manufacturing and battery technology, and further resulting in millions of vehicles getting sold in various countries. Most people now see that there are numerous benefits to using electric cars. One of these is the significant cost savings on running and maintenance. Running and maintenance costs are a major part of the ownership cost of any vehicle, and it is now well established that electric vehicle buyers spend much less on energy and maintenance, as electric vehicles have fewer moving parts than a gasoline engine, which makes it easier to maintain. There is also the part of convenient charging and ease of use. Electric vehicles rely on electricity to charge their batteries instead of using fossil fuels like petrol or diesel. With more electric vehicle battery charging stations popping up now, it will be easier for the users to charge the batteries at a nearby station rather than wait in a long queue at petrol pumps. The electric vehicle owners can also choose to charge the batteries with charging equipment from the comfort of their homes. While there are several factors that support the growth of electric vehicles, government policies have encouraged more people to consider buying an electric vehicle. Several governments globally are encouraging the electric vehicle industry through subsidies and regulations, and the consumers are demanding low-emission transport options instead of the fossil fuel-driven options. No doubt, recession is coming, and this will most likely affect electric vehicle demand. Several analysts globally have predicted that recession will likely take its toll on the demand for electric cars. Morgan Stanley Adam Jonas has also warned that as electric vehicles move from a state of acute undersupply to potential oversupply, investors must discount rising risk of negative earnings revisions for the year 2023. That dynamic hits an industry with high relative valuations and high costs. Morgan Stanley thinks 2023 could be a reset year for the electric vehicle market, where the last 2 years of demand exceeding supply will be substantially inverted to supply exceeding demand. Morgan Stanley analysts noted, within this environment, we believe players that are self-funded, that is, non-reliant on external capital funding, with demonstrated scale and cost leadership throughout the value chain, from manufacturing to upstream material supply, can be relative winners. In this light, the firm thinks that companies like Tesla and Rivian Automotive are likely to perform better than those like Frisker, Lucid Group, Li-Cycle Holdings, and many others, which may suffer even more during a recession. Over the past few weeks, Tesla cut prices in China on the Model Y and Model 3 for the second time in less than 3 months, and Rivian Automotive issued a deliveries report that missed expectations. With the economy at an inflection point between receding inflation fears and broad expectations of a recession beginning in 2023, the market doesn't know what to make of moves like Tesla's big price cuts in China, in the US, and in Europe. Even analysts like Guggenheim Securities' Ronald Jessicow have said that these price cuts could push Tesla's profit margins 25% lower than Wall Street's consensus and drain profits from all the automaker's competitors. On the other hand, Wedbush analyst Dan Ives thinks that this is the right move to jumpstart the EV transition amid macro uncertainty. According to Dan Ives, now is the time for Musk to lead Tesla through this period of softer demand, and not the time to be hands-off, which is the perception of the street. Ives described this as a fork-in-the-road type of year for Tesla, where it will either lay the groundwork for the next chapter of growth or continue its slide. The EV sector started off in 2023 with some fits and starts amid a rewiring of priorities in the market. However, Tesla is capable of driving industry prices lower, which gives it an edge over other EV makers. According to CFRA research analyst Garrett Nelson, Tesla is still the best positioned EV maker. The analysis believes that Tesla is not in any danger of a cash burn, but the company still has expected to have generated about $4 billion in late 2022 cash flow when it reports fourth quarter earnings in January, having had about $21 billion at the end of the third quarter. He stated that he thinks the stock will rebound quickly this year, adding that Tesla is his top pick amid other automakers, and noting that CFRA economists do not expect a recession. Nelson cited that Tesla trades at 24 times this year's profit estimates, which in turn only calls for 25% profit growth, numbers that are modest for a growth company with room to keep expanding fast. The analysis also cited that after the price cut, Tesla will see narrower profit margin, but will sell more cars. He added that this should widen the company's competitive advantage and make many more Tesla vehicles eligible for the $7,500 federal tax credit. Aside from having a competitive advantage in pricing, Tesla's huge on software too, not to mention that this year's earnings estimates assume no contribution from the Cybertruck, which Tesla is again promising to launch late this year, after being delayed since 2021. In respect to this, Goldman Sachs analyst Mark Delaney recently said that the vehicle deliveries should re-accelerate by mid-year, helped by lower cost structures at Tesla's newer factories and a pickup in Chinese sales. Tesla's goal is to increase demand while solving autonomy. The automaker plans to upgrade its car's autonomous capabilities in an incredible fashion, while updating the features of these cars with the aim of making them fully autonomous in no time. For more than 2 years, Tesla has been testing its FSD tech, and the car company has long offered a driver-assisted system called Autopilot, which can steer, brake, and accelerate its cars on highways. But FSD is different. It's an effort to extend this kind of technology beyond highways and onto streets, and if successful, Tesla would achieve an incredible feat, which would further secure its place as the leading EV producer. At the end of this decade, Tesla's going to be producing as many EVs as it can, without demand being a problem. It will also continue ramping up production at his factories globally. While many may argue that Tesla is recording slower car demand due to EVs, it is important to note that pricing is a poor indicator for demand when there is an incentive around the corner. Most EV buyers will wait for an incentive tax credit to take effect before purchasing an EV. It's simple, buyers would rather wait as long as they are aware that the car will sooner or later be sold for a lower price. And so, rather than stay worried about Tesla's perceived decline in demand, it's better for investors to look at the bright side of things, which is the enormous competitive advantage on pricing which Tesla will most likely continue to have. Do you think EV demand is dropping globally? Let us know down below and tell us what your valuation of Tesla is. And if you want to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.